Ladies and gentlemen, what you are witnessing right now is history. We have just seen the biggest drawdown on global fixed income on record, and US government treasuries bonds are in a bear market and have seen one of their biggest declines on record. And people, you definitely have to pay attention to what's happening with the bond market and the global fixed income market, because this market is much bigger than the stock market, and these markets are the global economic machine. So everyone, exactly what is happening? What's the news, the facts, and the data? Well, let's not waste any time. Let's get straight into it. Look at this, everyone. This is now the worst drawdown on record for global fixed income. The worst inflation in decades is hammering fixed income markets. Stagflation risks are leaving credit particularly vulnerable. And I don't know why all these economists are still thinking if we are in stagflation or not. GDP is forecasted to grow at 2% and we have inflation of 8%. So in real terms, we are already in a recession. So listen to this. Global bond markets have suffered unprecedented losses since peaking last year as central banks, including the Federal Reserve, look to tighten policy to combat surging inflation. And that's definitely true, everyone. We can see here the TLT ETF. That peaked around the 31st of July and is now down almost 25% from its peak, and is down 10% just over the past year. So what has historically been the safest asset of all is now in a bear market and is now down more than the Nasdaq high growth, high speculative tech sector. The Bloomberg Global Aggregate Index, a benchmark for government and corporate debt total returns, has fallen 11% from a high in January 2021. That's the biggest decline from peak in data stretching back to 1990. That is absolutely crazy, everyone, and it's definitely time to start paying attention. That surpasses a 10.8% drawdown during the financial crisis in 2008, and it equates to a drop in the index market value of about 2.6 trillion. That is worse than the global financial crisis of 2008. So I'll bring up a chart here and we can see how this is the biggest decline on record. So this is a big blow for money managers, and also this is another big blow for retirees that have already been suffering due to inflation. Now their fixed income assets, which were meant to be safe during retirement, are absolutely plummeting, wiping out their nest egg. And with inflation surging around the globe, with central banks going into quantitative tightening, with central banks likely to start selling off some of these bonds and these credit assets, I think this downturn is only going to get worse. And we have a look here, the 10-year US Treasury yield has gone over 2.4%. These surging yields have come after Jerome Powell has come out to said that the Federal Reserve is going to get more aggressive with hiking interest rates. And he said a half a percentage point or 50 basis point rate hike is not off the table in May. Higher borrowing costs risk further dampening the return on debt, eroded by the fastest pace of consumer price increases in decades. Soaring commodity prices following Russia's invasion of Ukraine risk worsening the outlook. Corporate bonds are particularly vulnerable to mounting stagflation threats, as slowing economic growth also raises credit risks. So the retreat in both stocks and bonds at the same time is really upending the dynamics of the traditional 60-40 portfolio, where people have 60% of the assets in equities and 40% of the assets in bonds to protect themselves against these downturns. The meltdown in global debt markets is a reminder of the Fed's tightening cycle in 2018, though the broad global bond index wound up losing only 1.7% for that full year. But unlike 4 years ago, price pressures are now much stronger and the global supply chain beleaguered. So everyone, what this means in simple terms is it looks like the market is in a liquidity crisis. And also what this could mean is investors don't think they're going to get a good rate of return on these bonds that are only returning between 2 and 2.5%. Especially when inflation is 8%, I have no idea why people would want to be investing in bonds right now, especially when the Federal Reserve is going to start dumping their $9 trillion balance sheet. So I run this, which is a quick urgent update. What do you think about this? Let me know. Now, as quickly for my viewers, Moo is doing a special promotion this month where if you deposit any amount, you get 3 free stocks and 1 guaranteed stock of Neo. It's definitely a great promotion. I'll put a link in the description and a pinned comment. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you in the next video.